What's going on, guys? In this video we're going to be going over a snippet of the one-on-one call I had with Sabrina. We're going to go over why it is that gaps tend to fill. We're also going to look at a trade setup happening on Apple, and hopefully the main takeaway from that is some good trade management skills. Without further ado, let's get into it. The main things that I'm looking at here and why this is attractive is because we have a big gap up, right? Apple gapped up this morning. That's kind of this area of the chart over here. And then it sold off and it started to fill the gap. So that to me right away is just a signal that people who were overnight, who bought overnight, were wrong about the direction. So you got to imagine that, excuse me, let me just turn overnight data on real quick. Cool. So right here, you have to imagine that all the people who are buying shares up here in this area, as soon as Apple started to pull back, they had to sell to get out of their positions because they were wrong, essentially. The price wasn't going to continue higher the next morning. So again, that's kind of the psychology and letting the chart tell you the story. That's kind of why gaps tend to fill, is because all these people were wrong. They have to then get out of their positions. Price tends to go down. But that essentially sets up the context for the rest of the day, which is important because now that the gap has essentially filled to the downside, we have a downtrending day, right?
Mm-hmm.
So because we know that we're in a downtrend for the day, for the morning anyways, we're looking at previous points of resistance that price struggled to clear. So we have one there, and then we made a lower high here. And then, so what we were watching for here, or why this would have been a good setup anyways, is we have a large inverted hammer candle. You know, that upper wick is sort of signaling to us that there are potential sellers sitting up here. It's happening at a key resistance. It's happening after a nice move to the upside. So, you know, could Apple do something like that and continue much higher? It could, but on a downtrending day, you know, it's expected that the prevailing trend wants to remain intact, the downtrend wants to remain intact. And therefore, you know, this is kind of an overextended move to the upside on a downtrending day, especially after this nice run here. So to see that sellers were starting to step in, putting in that upper wick at a resistance point, you know, that to me would have been a nice short opportunity, looking to buy some puts to the downside. And in terms of what puts I would have been looking at, if we go over to the option chain, so these are the ones expiring on Friday. And again, just looking for the delta to be right, I would have probably been trading somewhere in here. Oops, that's not the right tool. Somewhere in there, right? So the 320s look pretty good just because there's plenty of volume on them. You can see there's 19,000 contracts traded. Our delta is 62, so even above 50. So plenty of meat on the bone to get our direction correct. And the one thing that, you know, doesn't look too attractive about that to me, now looking at it in hindsight, is the bid-ask spread. So we have 480 by 545. So right off the bat, you'd be losing, what is that, 65 cents. So almost a full delta just on spread there. So that might have made me reconsider. You know, maybe I would think about trading these ones here, the 317.50s. There's only a 25-cent spread, still getting that 50 delta, and there's still plenty of volume.
Okay.
So that's the thinking behind that trade. It would have been, again, just identifying that we're in a downtrend because the gap has filled, the momentum is to the downside. Long players overnight were wrong. They have to close their position. We're coming into a key resistance point, right? We have that and that, like we talked about. And the structure of that candle with the large upper wick would indicate that sellers are starting to step in. That, combined with the context of downtrend resistance, would just lead to an overall short bias trade. And so on a trade like this, I'll just give you some examples of how I would manage something like this. So let's say I did see this alert or see this setup happen, and I was looking to get short, I would wait for this red candle to form. So it's a good thing that we saw the red confirmation. We broke down below the low of that candle. So that's a signal to me that, okay, we can get into this trade. We have confirmation. So my entry point would have been somewhere around here. I would have put a stop loss above the wick of that candle to, again, allow for a little bit of wiggle room in case it wanted to come back up and retest that as resistance. Let's just redraw that. So stop loss, entry is somewhere in here. And to make this trade worth it, I would have had to at least get a two times return on my money. And if we look at, what that doubled is, it's kind of somewhere in, I don't know, would you say that's fair? Something like that?
Yeah.
Cool. So again, this is my risk. This is my reward. And I would be scaling out. Let's say if I had, again, if I bought three put contracts, I would start scaling out here. Even though price started to move all the way down here, no one could have predicted that. Just in terms of looking for that 1-to-2 ratio, I would have taken off, if I bought 3, I would have taken off 2 here, and then I would have held 1 and adjusted my stop loss down to sort of trail stop and potentially capture more of this move. And it looks like, based on the way I would have traded it, I probably, once I took them off here, I would have moved my stop loss to here. Let me just clear that and redraw that. So I would have moved my stop loss above the 50 SMA and above the wick of this candle here, because that's a new established resistance point, right? It got rejected from it once there. The 50 SMA is acting as resistance, so I know that I'm safe generally. Above it, that would have been my new stop loss, and I would have just waited for this thing to either roll over or stop me out. In this case, it rolled over. It would have been a nice scoring trade to the downside, and I'm not a fan of holding things overnight, so I probably would have taken the trade off somewhere in here. Even though it went lower on the day, I'm not a fan of that overnight headline risk, so I would have been out of the trade here regardless of what happened. So I hope you found that little snippet valuable. If you did, then I'm sure you would enjoy a full hour-long conversation where I can answer any questions you might have about trading in the markets in general. You can set up a call over at our website, tradebrigade.co/1-on-1, just like you see on the screen here. If not, that's cool too. Just enjoy our free resources here on YouTube. We also have a Discord, Instagram, and you can check out our free newsletter as well. With all that being said, I wish you a green trading week.